Hello and welcome. In this video, we will discuss one of the most important areas of IFRS 9 or BFRS 9 in Bangladesh, the Expected Credit Loss Model, commonly known as ECL. Under the previous accounting model, banks generally recognized impairment only after a loss event occurred. This was known as the incurred loss model. But IFRS 9 introduced a forward-looking approach. It requires banks and financial institutions to estimate and recognize possible credit losses earlier, even before actual default takes place. In simple words, ECL means the estimated loss that a bank may suffer feebler or fails to repay its loan or financial obligation. This is very important for banks because their major assets are loans, advances, investments, guarantees, and other credit exposures. If credit risk is not identified early, the financial statements may not show the real risk position of the bank. IFRS 9 uses a three-stage impairment model. Stage 1 includes performing assets. These are loans where credit risk has not increased significantly since initial recognition. For Stage 1 assets, banks recognize 12-month expected credit losses. For example, a regular corporate or retail loan with timely repayment and no warning signs may remain in Stage 1. Stage 2 includes underperforming assets. These are loans where credit risk has increased significantly, but the loan is not yet credit impaired. For Stage 2 assets, banks recognize lifetime expected credit losses. Examples may include delayed repayment, deterioration in the borrower's financial condition, repeated rescheduling, downgrade in internal rating, or adverse industry conditions. Stage 2 is very important because it captures early warning signals before the borrower becomes fully defaulted. Stage 3 includes credit-impaired assets. These are loans where there is clear evidence of impairment, such as default, serious financial difficulty, legal recovery process, bankruptcy, or non-performing status. For Stage 3 assets, banks also recognize lifetime expected credit losses, but the assessment becomes more detailed. The bank needs to consider recovery possibilities, collateral value, legal position, and expected cash flows. The basic ECL calculation is based on three important components. The first is probability of default, or PD. This means the likelihood that the borrower will default. The second is loss given default, or LGD. This means the percentage of exposure the bank expects to lose if default occurs after considering collateral and recovery. The third is exposure at default, or EADT. This means the expected outstanding amount at the time of default. A simple formula is ECL equals PEMT multiplied by EADT. For example, if the probability of default is 5%, loss given default is 40%, and exposure at default is 10 million taka, the expected credit loss will be 200 taka. However, in real banking practice, the calculation is not always this simple. Banks must also consider forward-looking information, such as GDP growth, inflation, interest rate movement, exchange rate changes, unemployment, export trends, and sector-specific risks. For Bangladesh, this may include risks relating to garments, construction, real estate, import-based businesses, SME borrowers, agriculture, and export-oriented industries. IFRS 9 also requires scenario analysis. Banks may use a base case, optimistic case, and pessimistic case, and assign probability weights to each scenario. This helps make the ECL estimate more balanced and realistic. Successful ECL implementation also requires strong governance, finance, credit risk, IT, internal audit, senior management, and the board must work together. Banks should maintain clear policies, proper staging criteria, a definition of default, reliable data, approved assumptions, model validation, and strong documentation. For banks and financial institutions in Bangladesh, the main challenge will not only be understanding the accounting standard. The bigger challenge will be collecting quality data, building reliable models, training staff, and ensuring proper coordination among different departments. In summary, the expected credit loss model is the heart of IFRS 9 implementation. It helps banks recognize credit risk earlier, make better provisions, improve transparency, and present more realistic financial statements. In the next chapter, we will discuss the practical implementation steps for ECL, including data requirements, model development, and internal control considerations. Thank you for watching.